In this lesson, we're going to explore Bollinger Bands, a versatile and widely used tool in technical analysis. Bollinger Bands help traders identify potential overbought or oversold conditions, as well as periods of increased or decreased volatility. By the end of this lesson, you'll have a solid understanding of how Bollinger Bands work and how you can incorporate them into your trading strategy. Let's get started. So, what exactly are Bollinger Bands? Bollinger Bands are a set of 3 lines plotted on a price chart. They consist of a middle band, which is typically a 20-day simple moving average, SMA, and 2 outer bands that are placed 2 standard deviations above and below the middle band. These bands expand and contract based on market volatility. When the market is more volatile, the bands widen, and when the market is less volatile, the bands contract. This dynamic nature makes Bollinger Bands an excellent tool for identifying overbought or oversold conditions and predicting potential price reversals. Let's take a quick look at how Bollinger Bands are calculated. The middle band is simply the 20-day SMA, which we've covered in previous lessons. The upper and lower bands are calculated by adding and subtracting 2 standard deviations of the price from the middle band. The standard deviation is a measure of how spread out the prices are over the period. By using 2 standard deviations, Bollinger Bands capture approximately 95% of the price action, which helps you identify when prices are moving outside of their usual range. Now that we know how Bollinger Bands are calculated, let's talk about how to interpret them. There are a few key concepts to keep in mind. 1. Bollinger Band squeeze. This occurs when the bands contract tightly around the price. A squeeze indicates a period of low volatility and is often followed by a significant price movement, though the direction of the move isn't indicated by the squeeze alone. 2. Bollinger Band expansion. When the bands widen, it indicates increased volatility. After a period of expansion, prices may revert to the mean or middle band. And 3. Overbought and oversold conditions. When the price touches the upper band, it may be overbought, suggesting that the price could soon decline. When the price touches the lower band, it may be oversold, indicating a potential price increase. If you want to see Bollinger Bands in action for yourself, then sign up for a free trading account on Kraken and get access to this and hundreds more popular trading indicators. These signals can help you identify potential trading opportunities, especially when used in combination with other indicators such as the Relative Strength Index or Moving Average Convergence Diversion. So, how can you use Bollinger Bands in your trading strategy? Here are some practical tips. 1. Identify breakouts with squeezes. Look for a Bollinger Band squeeze, followed by a sharp price movement outside the bands. This could signal the beginning of a new trend. 2. Trade the reversion to the mean. When the price touches or moves beyond the upper or lower band, consider trading in the opposite direction, aiming for the price to revert to the middle band. 3. Confirm signals with other indicators. Use Bollinger Bands alongside other indicators like RSI or MACD to confirm potential trades and avoid false signals. To summarize, Bollinger Bands are a powerful tool for understanding market volatility and identifying potential overbought or oversold conditions. By learning to recognize squeezes, expansions, and price movements relative to the bands, you can add an extra layer of insight to your trading strategy. Thank you for joining me today. Keep practicing with Bollinger Bands, and don't hesitate to revisit this lesson if you need a refresher. See you in the next lesson, where we'll continue building on these concepts.